If you're actively trying to navigate the DMV real estate market right now, you're hitting the exact same wall everyone else is. Interest rates are higher than they were a few years ago, which makes the monthly payment on that Bethesda single-family home or a Arlington townhome feel incredibly steep. To solve this, the mortgage industry has aggressively started pushing a tool called a 2-1 buydown. You hear about it on the news. You see retail lenders advertising it, and you see sellers offering it in their listings. But here's the glaring flaw. Most people, they completely misunderstand how it actually works. It's being pitched as a magic wand to make housing affordable again, but in reality, it's a very specific approach that requires careful upfront planning. I'm Chris Choe, and today we're going to be taking a hard look at the 2-1 buydown. Whether you're a buyer trying to manage your monthly cash flow or a real estate agent just trying to negotiate the best possible deal for your client, you need to understand exactly how this works. So let's get into it. To understand the 2-1 buydown, we just have to look at the numbers. A 2-1 buydown isn't a permanent interest rate reduction. It's a temporary discount. Here's exactly how it breaks down. Let's say your standard 30-year fixed rate is locked in at 7%. With a 2-1 buydown, your interest rate for the first 12 months of the loan is reduced by 2%. So in year one, you're making payments as if it's a 5% interest rate. In year two, the rate is reduced by 1%. So you make payments as if the rate is at 6%. Then in year three, the discount ends. For the remaining 28 years of the loan, your rate goes back to the baseline interest rate of 7%. But here's the most important fact. The lender doesn't give you this discount for free. The difference in the monthly payment for those first 2 years has to be paid upfront in cash. That cash is placed into an escrow account at closing, and the lender pulls from that account every month to cover the difference in your payment. To make this plan work, you typically negotiate for the seller to pay that upfront cash in the form of seller's concessions. Now, this brings us to the catch that retail lenders often gloss over when they pitch this to buyers. Many massive call center lenders pitch the 2-1 buydown as a way to afford more house. They tell buyers, don't worry about the 7% rate. Look at how cheap the year one payment is. That's incredibly dangerous advice. The truth is, under standard loan guidelines, you don't get to qualify for the mortgage based on the discounted 5% rate. The underwriter is going to calculate your debt to income ratio based on the permanent 7% interest rate. Again, the permanent 7% interest rate. If your income can't support the full year three payments, you won't get that loan, no matter how attractive the year one payment looks like. This approach isn't a cheat code to buy a house that you can't afford. It's a tool to preserve your cash flow during the first 2 years of home ownership so that you can rebuild your savings after paying your down payment. If you want to understand how to set up your timeline and gain the leverage needed to actually pull this off, I put together a free 19-minute masterclass. It shows you exactly how to flip the traditional 30-day mortgage process upside down. It explains how to utilize the upfront underwriting, where we review your file rigorously against loan guidelines early on, so you can execute a fast close and beat cash buyers. I'll leave a link in the description below, but before you can flip the timeline, you need to master the negotiation. If the 2-1 buydown is widely misunderstood, then what's the fix? What should the standard be for buyers and real estate agents operating in the DMV? Well, the standard is understanding how to use this at the negotiating table. If you're a real estate agent representing a buyer, you know that asking a seller for a $10,000 price reduction on a $700,000 home barely changes the buyer's monthly payment. A $10,000 price drop might save your client like $60 or $70 a month. It just doesn't move the needle very much. But if you use your leverage to ask the seller to keep the price the same, but then give back that $10,000 back as a seller concession to fund a 2-1 buydown, now you're fundamentally changing the buyer's quality of life. That same $10,000 applied to a buydown could save your buyer $400, $500, or even $600 a month during that crucial first year. That's a standard you should demand. The buyer gets the peace of mind of a highly affordable payment while they settle into the house, And the realtor delivers a smart negotiation that actually solves their client's cash flow problem. Now, we need to have a reality check about how this actually plays out in a hyper-competitive market like the DMV. So in the DMV, you can't just walk up to a seller and ask for $10,000 in seller concessions to fund your buydown if your offer looks weak. If you're coming in with a standard unverified pre-approval letter or a pre-qual letter, the seller is going to ignore your request and take that all-cash offer instead. So to ask for concessions, you must have an absolute leverage. Your financing has to look bulletproof. And because the market changes constantly, you shouldn't work with any professional who guarantees you a specific outcome upfront. In this industry, there is no absolute certainty until the loan is officially clear to close. So what a proper upfront review against loan guidelines provides is clarity and confidence. When your file is rigorously reviewed early and your realtor knows exactly what the buydown numbers look like, you can then present an offer that's clean, fast, and built to win. So you aren't guessing, you're actually executing. The verdict on the 2-1 buydown is simple. It isn't a gimmick, but it's also not a magic fix for unaffordability. It's a smart financial tool. When used correctly by a buyer or a skilled realtor, it's one of the most efficient ways to use seller concession to protect your cash flow. If you're a buyer or an agent in the DMV and you want to see exactly how to utilize this upfront underwriting to review your file against loan guidelines, gain that ultimate leverage, and execute a fast close so that you can beat cash buyers, go watch that free masterclass in the link in the description below. Grab a notepad, learn the steps, and demand a higher standard for your real estate transaction. Well, that's it. I'm Chris Choe. Thanks for watching, and I'll catch you in the next one.